Okay, so it's 11 o'clock. Welcome everybody to Pensions Online's session on pensions with Andy Dixon from Harvest. Andy, you've kindly given this style of presentation to us a few times now at this point, and it's always very helpful for business owners to understand the pension system and how it might affect us as business owners. So thank you very much for joining us again.
No problem.
Good so you're going to go through some slides with us and talk to us about retirement planning, and then just to encourage anybody who's got any questions about it. It is a bit fuzzy, for a lot of us who are not familiar with pensions. Also, those of us who maybe are hearing about it for the first time, but do put any questions that you have in the chat, and we'll answer them throughout the course of the morning. And do follow up then with any questions to ourselves or to Andy at Harvest. Harvest is one of the biggest pension companies in the country. Would that be right, Andy? You're a broker, essentially, really, isn't that right?
Yes, that's right. There's probably a slight difference between us and other brokers in that we actually manufacture our own pension products as well.
Oh, yeah.
Act as agents with the life companies. Yeah.
Very good. Okay. So tell us, what should we be thinking about now as business owners, whether right now or 10 years time or 20 years time? What?
Sure. Okay. Well, I thought it was interesting that you said this could be somewhat fuzzy for people that aren't too familiar with pensions and the Irish pension system as a whole. But that was interesting because at the moment, and it sort of leads me into the first part of the presentation, but at the moment we're living in pretty unprecedented times in the Irish industry.
Oh, really? Okay.
Yeah, and it's actually, and I'll go through this, but it's fuzzy for us at the moment.
Okay.
In particular, because of recent pensions legislation and how it was actually implemented.
Okay.
So I wouldn't usually start with an update around pensions legislation because I'm aware that it's not really the first thing that clients want to talk about when it comes to retirement planning and that side of things. But it is quite relevant at the moment because there's a hopefully very temporary short-term lack of clarity around pension options, particularly for limited company business owners.
Okay.
And so I do need to address that. Now that will hopefully be resolved by the end of September. That's the sort of noises that we're hearing from the life companies and from the Pensions Authority. But unfortunately, I have to start with an update on legislation. So I'll try to keep it as high level as possible. But
please do. Yeah.
That's where we're going to start. Notwithstanding that slight lack of clarity at the moment, I'm going to talk about what the likely options will be for company owners and pension funding. And that will kind of be the heavier part of the presentation. Then I'll get into sort of general retirement planning and how a company director or a business owner might go about kind of building a retirement plan. And then I'll just sum up just some final thoughts, and I'll touch on self-administered pensions there. But all of this, as I say, is sort of in the context of these recent developments in the Irish pension system.
Okay.
So that being said, as I said, the first thing I'll just talk about is the just an update on the Irish pension system as a whole.
Mm-hmm.
It's probably worth starting with the government's agenda and how they are addressing, I suppose, some pretty fundamental issues in the Irish pension system. Okay, so we're all aware, and I won't go through it in too much detail, but we're probably all aware by this point about concerns around the state pension system. Obviously, as a result of the demographics in Ireland, which are not dissimilar to demographics elsewhere in the developed world, we are sort of fast approaching a point where we're going to have 3 pensioners for every 1 person working. And obviously the state pension system is such that it's funded by people who are working and PRSI contributions and all the rest of that. So, so clearly this is all set against the backdrop of concerns with a lack of adequacy in Ireland around people actually funding for their retirement, because
Yeah.
living off the state pension alone is difficult, especially if you don't own your own home, and we all know the issues in terms of the housing market and how that's progressing. So clearly, as a result of this, the government and the pension authority want to encourage private pension funding in order to help people, or to encourage people, I suppose, to bridge that gap between what they'll need in retirement and the state pension, in whatever level it will be payable when we all reach retirement. So the first way they're looking to do that is through auto enrollment. Okay, so in a lot of other jurisdictions, they basically have an opt-out pension system when it comes to occupational pensions. So any employer in other jurisdictions, including the UK, has to enroll employees in a pension scheme, and employees have the option to opt out then. So basically, very few people do opt out. Most people stay in, and it just sort of encourages, a habit of saving for retirement. Whereas in Ireland at the moment, you have to opt in, you have to sign up to a pension.
Yeah.
Obviously, behavioral finance comes into it, but if you give people the choice to opt out, they tend to stay in. If you give them the choice to opt in, maybe 50% of people will actually join a pension scheme.
Okay.
So that's going to be quite significant for employers, and I'm not really talking about company directors, but for employers, they're going to have a group pension scheme in place. And at the moment, the likely timeline is probably the middle of next year. That's going to have to be in place. So that's a significant consideration for company owners, obviously, when they're considering their employees. Doesn't really have too much impact on them themselves in terms of building a retirement plan, because they should still be able to separate their own pension funding from that of their employees. Okay.
And Andy, did you say it's the end of September we're going to find out that will come into play, or?
That's really in relation to the next part. So these significant changes to occupational pensions, but particularly for company directors who are looking to fund themselves, okay, rather than their employees. So in terms of setting up pension schemes for employees, and obviously keep an eye on the news, but that is likely to, the auto enrollment scheme is likely to come into force next year, okay. But in terms of company directors, which is a very distinct, a separate part of the conversation, and that's really what I'm talking about today, business owners looking to fund, the lack of clarity, excuse me, the lack of clarity at the moment should be resolved by September. Okay. So this last bit, the question mark, the significant changes to occupational pensions, that's really that's the current lack of clarity around company directors funding, and that's what I'm going to get to in the next.
Okay. So auto enrollment is likely to come in for all our employees. So a lot of our business owners will have staff. They need to consider that the impact on their financials for their company very soon. And then you're going to tell us about, our own pensions as directors.
Exactly. Yeah. Which is really, like, today's presentation is all about business owners,
Sure.
That would tend to be our area of specialty.
Yeah.
So as I say, there are some significant changes underway, and I'm going to try and summarize those in a way that I don't bore all the attendees. But basically, the Pension Authority, which is the regulatory body that oversees directors' pension schemes, as part of this overall government agenda of addressing the Irish pension system and all the flaws that are currently inherent in it. The Pension Authority have a very clear agenda to reduce the number of pension schemes in Ireland. Okay, so they have to regulate even one-man directors' pension schemes the same way in which they regulate, say, an employee scheme that might have 1,000 members or 500 members. Okay, so as far as they're concerned, a scheme is a scheme. It doesn't matter how many members, be it one director just funding themselves or a number of employees. And it's quite interesting, if you look at the pie charts, in Ireland, we have somewhere in the region of 110,000 pension schemes, okay, including directors' pension schemes. That's more than the rest of the EU put together, okay? And the Pension Authority is obviously responsible for regulating the providers of all of these separate pension schemes. So they are quite advanced in their agenda of restructuring the occupational pension scheme market, so that there are a small number of pension schemes basically amalgamating together into a number of what are called master trusts. I won't go into what master trusts are, but essentially what you're going to have is 7 or 8 master trusts, so pension providers in Ireland, and all of the employee pension schemes are going to be pushed across into these master trusts, and that's happening at the moment. That's supposed to happen by the end of the year. Okay, so that's a bit of a backdrop. They basically want to reduce the number of
Andy, we've lost your audio. No, can't hear you. Now, I think there's audio coming through now. Yeah.
I'm back, am I?
Yeah, thank you. Yep.
Okay. Sorry, not sure what happened there. Okay, so this essentially is the legislation that's being introduced. Okay, and I'm not going to go through this in a massive amount of detail. I will get to the point shortly, but essentially, what they're trying to do is increase. I'm not saying this is what they're trying to do, but this is the implications of the legislation that they've implemented in Ireland. They're basically increasing the costs and the complexity of occupational pension schemes, okay, including one-man pension schemes. And this is obviously going to encourage employers to move their pension schemes into these master trusts that I talked about, okay? So a whole range of restrictions as to what scheme members can invest in, a whole range of additional policies to be put in place, including things like standards of member communication, and greater obligation on pension trustees, okay? And a lot of occupational pension schemes would have the member acting as a trustee. The director would often act as a trustee. And those obligations, if you're not compliant with them, the penalties include criminal prosecution of trustees. So obviously, if you're an employer acting as a trustee and you're not necessarily a pension professional, and you hear that if your scheme is not compliant, you might be liable for criminal prosecution. This is all encouraging this movement of larger employee pension schemes into these master trusts, okay? Now, what we thought would happen was that directors' pensions would be exempt, okay, and that it would only apply to large group pension schemes, okay? But when they introduced this legislation last year, there was no exemption for one-man schemes, so for company directors, okay? Now, the pensions industry sort of took the view that this is probably a mistake and they're going to row back on this, you know, because they had done in the past. And the deadline for compliance for all pension schemes was July of this year. And what happened in July was that the Pensions Authority called in all the scheme providers to have a chat and basically said that there was not going to be any exemption for one member schemes, so for directors' pension schemes, and that they would have zero tolerance for non-compliance. Okay, so a bit of a shot across the bows of the pension industry. But basically what it's meant is that all the providers, all the life company providers, all the self-administered providers such as ourselves are currently scrambling. We're all in limbo basically, because we want to make sure that all of our, including the life companies, all of the one-member schemes are going to be compliant with this new legislation, which I've already said quite onerous, okay? So this is the piece that we're currently unclear as to what the options are for company directors. Now we know what they're likely to be, and I'll talk about that. But that's the piece that we're expecting clarity at the end of September. Okay, so not a great picture for the pensions industry, and it's really impacted company directors who are looking to fund. You know, if you had a company year end at the end of August, you were goosed. Yeah. We couldn't advise you as to what the most appropriate structure was. But we do expect clarity, and we've been talking to obviously to the Pensions Authority and to the life companies. And we do expect clarity in the next 3 weeks. So I'm going to talk about what the likely outcome is going to be.
Okay, Andy, you probably go through this, but just a question around when you mentioned directors, we may have business owners here who are sole traders. Yep. Will your presentation cover for sole traders as well? Yep.
It will. And thankfully, there's no change to that. Okay. So
Okay.
I think it might be the next slide, but I usually break down the options for sole traders and limited company directors as well. Sole traders aren't affected by this. Limited company pension options are. Okay. So I'm going to break that down. I think it's in the next slide, Rose.
Thanks.
So, with that backdrop, you know, as I say, it's pretty unprecedented. I've never experienced a situation where I can't tell a client what the best option is for pension funding. But behind, you know, with that backdrop in mind, what are the likely options going to be in 3 weeks' time at the end of September? That's what I'm going to cover next. And I'm pretty confident this will be the case. But obviously, if anything changes, Rose, I'll let you know, and we can have another session just
sure.
Through the reality maybe in October if there are any differences.
Yeah.
Okay, so basically, as of June, before that deadline, the top half of the slide were the options, okay, for pension structures for both sole traders and limited companies to use. Okay, so if you're set up as a sole trader, nothing has changed. You essentially have two options to use for funding for retirement into a tax-approved structure, which is the pension structure, obviously. So the first is a personal pension plan, and the second is a PRSA. Okay, there's not much difference in the two. The only real difference would be the investment options available under a personal pension plan. Okay, so if I was to decide on one of those two structures, I was a sole trader, I would usually go for a PRSA, to be honest. And the reason for that is a PRSA is a much more portable pension contract. It's much more easy to move it into other pension funds or pension structures in the future. Okay, so very little difference between the two, really. In reality, the same tax treatment applies. And I'll talk about the tax reliefs available shortly. But if it was my choice and I'm set up as a sole trader, I would typically ask for a PRSA. Okay. And the primary reason for that is if in the future I become an employee, whether that's a company director. So if I do transition from sole trader to a limited co at some point, or for example, if I just become an employee, you know, of another company at some point in the future, you can actually move a PRSA straight into that new pension fund if you set one up. Okay. So it's very, very portable, very easy to move. You can't do that with a personal pension plan. Okay, so all the rules around tax relief, all the rules around how and when you can access the pension fund, they're all pretty similar. But a PRSA is just a bit more flexible. And if I was guessing, I would say that at some point in this whole simplification agenda, you know, trying to streamline the pension industry and the whole pension framework in Ireland, I think they might well get rid of the personal pension completely. Okay. So my advice would be, without obviously having sat down with a client and gone through their circumstances, but my advice in most cases would be to set up a PRSA if you're a sole trader. Okay, purely because it's more portable in the future. Okay. Prior to July and that lack of clarity I've gone through, the options for a limited company were a PRSA as well, or an occupational pension scheme, so a director's pension plan essentially. And the director's pension plan was usually by far the better option for a limited company director. The reason for that is you can pay in multiples of your salary in a lot of cases into a pension fund through an occupational pension. If you have a particularly good year, for example, and the surplus cash on the company balance sheet, you have a lot more flexibility as to how much you can get out of the company into an occupational pension than into a PRSA. You can get a lot less into a PRSA. So if you're a sole trader, I go with the PRSA. And if you were a limited company, we would have said go with the occupational pension plan. Okay. Now, as I said, in September, there's a big gap there down the bottom right, because that occupational pension plan currently is unclear as to what the option is as I speak today. We should have some clarity, as I said, in a few weeks. But at the moment, if you were to set up a plan today, the only plan that we could set up for you would be a PRSA if you were a limited company, if you were set up as a limited company. Okay. So summary, if you're a sole trader, it's likely I'd recommend a PRSA. Same tax benefits as the personal pension plan, but just more flexible. If you're a limited company, I would have said an occupational pension plan. However, there's a bit of lack of clarity as to what that's going to look like, okay, at the moment.
And Andy,
Yep.
can we if we are sole traders, can we keep both the PRSA and the personal pension, or can we only have one plan?
If you have an existing personal pension plan, I would actually just say just keep contributing into that. Personally, you know, the benefits of setting up a separate PRSA as well as having a personal pension plan, you know, it means more paperwork. It means you keeping track of two different funds. I wouldn't necessarily suggest that. You know, it also might mean you're paying two sets of fees essentially. So if you already have a personal pension plan, just keep contributing into that. If you do subsequently set up as a limited company and you want to transfer that into your new occupational pension scheme, you can actually move it into a PRSA and then move the PRSA into the occupational pension scheme. Okay, so it can still be done, just an additional step to be taken. So I would say if you already have a personal pension plan, just keep contributing into that.
Okay. Thank you.
No problem. Okay, so what's the likely scenario then? So I mentioned, you know, we don't know what's going to happen, but we have a pretty good idea. So what's the likely scenario for limited companies? For sole traders, it's still unchanged, and there's no massive concern at the moment around any kind of lack of clarity. But for limited company directors, this is likely to be the eventual outcome, you know, and we should know in 3 weeks as to whether or not this is the case. But basically what you're going to have is two options under the occupational pension route. Okay, one is an executive pension under the master trust. So I've already discussed the master trusts as these big trusts under which all the employees are being moved, all those pension schemes. It looks like you're going to have master trusts as well for an executive pension plan, okay, a director's pension plan. So basically what that'll look like, you'll have all the same tax benefits, tax relief, and tax-free growth and all the rest of that, which I will talk about. But you'll have pretty standard investment choices. So these master trusts are going to be designed for large group schemes, employees who don't really require, you know, massive bespoking of investment options or off-market assets or anything like that. They just want sort of pretty vanilla multi-asset investment options with very little risk. I suppose I have to be careful with how I phrase that, but minimal risk. And it's likely that if you're setting up an executive pension plan after September with a life company, you'll be going into one of these master trusts. Okay, they'll be perfectly fit for purpose. You can invest in a multi-asset portfolio that should be quite flexible. You can choose through an advisor, obviously, how much you want to invest in equities, how much you want to invest in commercial property and all that type of stuff. But they'll be pretty standardized. So really more geared towards the mass market employee rather than a company director. Okay. So you're going to have that option. And then you'll also more than likely have a self-administered director's option. Okay, as well. So that self-administered option will still be there. You'll have more flexibility than in a master trust around the investments, but it will still be probably more restrictive than it is today. So there'll be restrictions on things like off-market assets like property and stuff like that. And again, I'll explain that in a few slides. But basically, this will more than likely be the scenario after the end of September for company directors. On one hand, a pretty vanilla offering through a life company, not a problem, perfectly fit for purpose, still very tax efficient. On the other hand, more flexibility through a self-directed option, but slightly more restrictive than a self-directed pension today. Okay.
And Andy, what's the difference between now, like with the master trust? You think they're just going to be, when you say pretty vanilla? Okay,
so a master trust, as I say, would be designed really for employees, okay, for large groups.
Oh yeah, okay.
So typically what would happen is when a member joins a group scheme, they'll complete a risk questionnaire and they might come out as a cautious investor, or they might come out as an aggressive investor. And there's a couple of categories in between. So if you're a cautious investor, you're going to go into a multi-asset portfolio designed by the life company.
Yeah.
Which will probably have a lot of exposure to lower risk assets like bonds, a bit of cash in there, maybe some alternatives, and quite quite a low weighting to equities. Okay, so equities over the long term perform very well, but they're very volatile. Okay, so if you're a cautious investor, that puts you into a multi-asset portfolio designed to reduce that volatility, but you won't get great returns over the long term. And if you come out as an aggressive investor or adventurous, then you'll go into a portfolio of the very same assets, but just with different weightings. So more of a weighting to equities, less of a weighting to bonds. Okay, so you probably have 4 different portfolios within that choice, with different weightings to equities. But that's basically more than likely what company directors will also have if they have this executive pension under the master trust as well.
Okay. So at the end of the day, it could mean just that it's less valuable for us as company directors. That's the kind of
yes, it could.
Here.
Yeah, it could. Now it really depends on what your priorities are. So
yeah,
some clients just want to avail of the tax efficiencies. They don't want anything bespoke or to have great involvement in the investments. They're happy to leave that to the life companies to run. Okay, and as I said, those the portfolios that the life companies have produced have pretty much done what they're designed to do. So the lower risk portfolios have produced, say, returns of 2 to 3% long term. The higher risk portfolios sort of 5 to 6%. So they've done what they're designed to do. So we don't have a problem with them. So if your priority is really just kind of build a retirement plan and let me know what I can expect in retirement, and I don't really want to get involved in the investment side of things, they're fine. There's no problem at all. And we've no problem recommending them. Sorry, go on.
A question from David is, if we do the self-administered director's pension instead of the master trust, will the self-admin director's pension, is that more costly, like annual management charges, etc.? You might be talking about that later.
Yeah, I don't actually get into charges, but it will be. And the reason for that is all those additional obligations under IORPS, that new legislation. So things like the trustee policies, the investment policies, all the rest of that, the member communication is going to lead to additional cost. Okay.
Yeah.
So all the pensioner trustees, all the pensioner trustee firms, ourselves included, are currently trying to work out what we're going to have to charge and what the lowest level of fund, I suppose, is. A client would need to be at to move to a self-directed structure. For it to be cost effective. So so if you have a larger fund, it'll be cheaper, and if you have a lower fund, it'll be more expensive, because you're basically looking at and please don't hold me to this, but I would think the industry standard might well become about €5,000 a year for a self-administered pension. Okay.
Gives us an idea anyway.
Yeah, so that there's a capped fee structure on self-administered pensions typically.
Okay.
So you can see, obviously, the larger your fund, the more cost effective it becomes. The lower your fund, the more expensive it becomes, because you would just be charged a flat fee every year.
So you really want to know that there was going to be better outcomes from the self-administered versus the vanilla master trust. Then
exactly,
it's hard to know, probably.
Yeah, having said that, you're probably looking at somewhere in the region of 0.6% of an annual management charge on the master trust. Okay. So the difference with the master trust is, as your fund grows, the fees go up as well, because they're just charging a percentage of the fund. Whereas the self-administered structure, usually there'll just be that flat fee.
And it has a cap. Okay.
Exactly. So there will be a tipping point at which it becomes much more cost effective to move to a self-administered arrangement.
Okay.
You get the benefits around the investment flexibility.
Yep.
So that's if you're starting off, certainly have a chat with us. If you're in a limited company, then you might have the ability to get a lot of cash off the balance sheet in one go. It's one of the benefits of the occupational scheme versus the PRSA. And that might mean you can get to that point at which it becomes cost effective quite quickly. But anyway, so that's more than likely the scenario for limited company. And I know I have focused on limited companies more so than sole traders, Rose. That's just because of this lack of clarity. So
sure.
just to recap, sole traders, PRSA or personal pension plan, recommendation would usually be a PRSA. Although if you have a personal pension, keep contributing to it. Don't set up two. If you're a limited company, I would, if you can, unless the company year end is upcoming, I would hold off until first week in October, and then there should be a bit of clarity. And these will be your two choices more than likely. Okay. So hopefully there's a little bit of clarity, I know, around what the likely scenario is going to be for company directors. As I say, sole traders don't need to worry.
Okay.
Okay, so it's probably just worth recapping why you would use a pension at all to fund for retirement, because obviously you can save in a bank account, or you could save into other sort of non-pension savings products, sold by the life companies. And really it comes down to tax relief. Whether you're a sole trader or a company, a limited company, there's a great array of tax benefits on the way in. So if the company's making contributions on your behalf, then there's no income tax, USC, PRSI, or BAK paid on those employer pension contributions. The company also gets corporation tax relief on those employer contributions as well, so that there's an offset there. And then also for sole traders, and also if you're making personal contributions into an occupational scheme yourself, you get your marginal rate tax relief on those personal contributions, okay, be that into a PRSA or into an occupational pension scheme. So very tax efficient on the way in, and you do get to offset contributions against both personal income tax and corporation tax relief, or corporation tax if that's applicable. Within the fund, any investment growth is tax-free as well. Okay, so if you're in a non-pension investment structure, best case scenario, you'll pay CGT, but you will pay 33% at the moment on any growth when you sell an investment. If you're invested in something that pays out an income within a pension fund, like an equity portfolio that pays out dividends, for example, or a property that pays out rental income, there's no tax on that investment income within the pension fund. Okay, so very tax efficient on the way in, very tax efficient when you're in the fund as well in terms of investment growth. And that obviously compounds over 20 years. That can make a significant difference. And then on the way out, when you actually come to take your retirement benefits, there's a tax-free lump sum available, which is up to a maximum of 200 grand. That's a quarter of the pension fund. So obviously you need a fund of 800 to pay out 200 grand tax-free. And then the rest of the fund goes into your post-retirement pension pot. So you get tax-free growth on that as well in retirement. So we like to break it down that way for clients. On the way in, you get tax relief on contributions. Within the fund, tax-free growth and income. And on the way out, there's some pretty sizable tax benefits as well. So it really is just all about the tax benefits applicable. That's why you would use a pension scheme as opposed to some other type of savings policy. Okay, so I suppose hopefully given some degree of clarity as around what the options are likely to be for sole traders and limited companies, talked a bit about why you'd use a pension in the first place. Okay, so why a pension recommendation as the product of choice, and that's primarily down to tax. Just want to talk now a little bit about the approach that we go through with business owners when we're kind of putting a retirement plan together. And the different aspects that we talk to clients about. So the first point we always make is that retirement planning really should be driven by your own retirement lifestyle objectives. Okay, and that tends to be the first conversation we have. We're trying to put a number on your income requirements in retirement. So how much income do you think you're going to need to live the lifestyle that you want in retirement? Okay. And all these other aspects, it's not just the financial aspect, but all these other aspects need to be brought into that conversation. So your estate planning wishes, obviously your own level of financial security is important, but whether or not you want to travel, volunteering, whatever you want to do in retirement, and the income you're going to need to support that lifestyle needs to be sort of central before we start any sort of financial planning exercise. Okay, so we do try and look after the financial side of things, but it's really just there to underpin all the non-financial aspects of your retirement. So just to kind of break out the different steps, then once we've determined that first point, which is your income needs and requirement, the other things that we need to factor in, obviously, are your likely age of drawing your pension benefits. So you do plan to retire at 60, or you're going to wait until state pension age, 66 at the moment, or do you want to retire earlier? Are you looking to maybe retire at 50 or 55? We do have business owners who've had a very good outcome. Maybe they sold their business and they now have clarity that, look, I think I'm going to be able to retire at 55. Can you just provide me with some comfort that is the case? Other sort of more technical things that we need to look at, often in conjunction with an accountancy firm, would be interaction with your other pension benefits. So you might have pension pots from previous employments. We have to obviously factor those in, and also interaction with other reliefs. So your tax advisor might be planning for retirement relief. They might be planning for entrepreneurs relief, or paying a termination payment, say. So we need to look at that and see, well, how much is left over for the pension, or is the pension preferable to one of these other reliefs, or is the other relief the way to go in terms of maximizing your tax efficiencies, basically. We obviously need to factor in your state pension entitlements. So, you may or may not have the full state pension entitlement, and you may or may not have other income, like rental income, that needs to be factored in. So that sort of gives us a picture of where you are today, what your pension funds are going to grow to, assuming a certain level of growth, how much cash you're going to be able to get out of the company through other reliefs if you're dealing with a tax advisor on that side of things, and then your state pension and other income. So you might say, I need 40 grand a year net income in retirement. And we can say, well, currently you're on course to get 30 grand a year. So what we need to do is find a way to bridge that gap.
Okay.
And that's the implementation piece. Okay. So in order to, in that example, to grow a fund, to get you an additional 10 grand of retirement income, you need to pay, €600 a month in a company contribution for the next 15 years. So that's sort of how we kind of work back from your income needs to where you are today, and then a plan to try and bridge that gap if there is a gap. Okay.
So it's a great benefit of being a business owner. It's hard to be a business owner and not just to rely on a salary in other ways, and there's greater risks associated with it. But this is a real benefit as business owners that we should make the most of, really, Andy, isn't it?
Yeah, I think so, Rose. And I mean, it's like business owners typically, and I know I'm generalizing here, but they're often quite time poor, like they're just focused on the day-to-day requirements, and often that, sure, we know ourselves here, Harvest, in terms of, adapting to things like changes in legislation and you kind of just have to react sometimes to things that are happening, and it can put plans to look at your own personal circumstances on hold for a while. But yeah, if you can find the time to think about even just that first step, your income requirements in retirement.
Yeah, because the state pension is certainly not going to look after us.
No, unless you've got a really, to be honest, even if you had a really, really low lifestyle sort of income requirement, everyone's fully aware of the pain that's coming down the road next year. Just the cost of living. And I don't know how people who are just on the state pension are going to be able to cope,
Yeah.
So you definitely do need, I would think, some additional income in most
Sure.
cases. And in fairness, that's why the government's bringing in that auto enrollment thing for the mass market.
Yeah.
But company owners, business owners, they often think that the business is nearly their pension, but the reality is, anything can happen.
Anything can happen. Yeah.
If you can take early steps to try and maybe look after yourself, then at least you've taken the time to do that, and then you can get back to running the business, and maybe just once a year to sit down and review how the pension side of things is going. But it is like, we'd often get business owners ring us saying, look, my company year end is tomorrow, I need to make a pension contribution, and they're kind of saying, well, we can't really get your scheme revenue approved in 24 hours. Do it for next year, but do it now, because otherwise you'll be in the same position next year. And to be honest, we often get a phone call from the same business owner the next year on the day before tax deadline, So We do appreciate that, but it is just finding the time to put a plan in place, you know,
Okay.
and it has huge benefits. Like there are tons of studies. I won't go through them and bore you with the details around the world that just show the difference between clients who deal with a financial planner and clients who don't. And the statistical long-term outcomes are way better with clients who just deal with one and just get a plan in place and sort of try and stick to it.
Yeah, yeah.
It does instill some discipline around the whole thing, you know.
Okay.
So enough said there. So yeah, I'm not going to go through this in too much detail, but essentially once you've put that lifestyle, that retirement plan in place, the life cycle of that retirement plan is basically initially funding. So that's the piece around determining that gap and us saying you need to pay in, you know, 600 a month or whatever it is into a pension scheme. So get the plan around the funding in place. Then you've got to decide on what you do with those funds. So how you invest them. Okay. And that's really down to what level of risk you want to take, how much you want the fund to grow, and are you comfortable? If you want the fund to grow, you've got to invest in more risky assets. So are you comfortable with more volatility in the short term? You know, if you're paying in monthly into a pension fund, it's less of a concern because if the markets fall in the short term, your next monthly premium just buys more units in that fund. So volatility can actually benefit you if you're paying in monthly. If you're paying in annually, it's probably more of a concern because you're only making, you know, lesser contributions. Over 10 years, you're only paying in 10 contributions. So timing will actually have more of an impact. So we'd say pay in as frequently as you can, and you can then afford to take more risk. The last piece then is that exit strategy. So ideally, as you get up to retirement age, you know, 3 or 4 years out at least, you're starting to have a much clearer picture as to what your pension fund is going to do for you, how much of a lump sum you can expect, and how much of a retirement income you can expect from the rest of your fund. Okay, so clearly, if you're 15 years out, we're looking at assumptions over a long term. If you're 3 or 4 years out, we have a pretty clear picture as to what you're going to get from your fund. So those assumptions become more and more accurate. And then the last piece really is in retirement, and this is still part of your whole, you know, financial retirement plan, because hopefully you will have a long and enjoyable retirement, and there's a requirement for financial planning advice throughout retirement because you're in the point where you're drawing down from pension funds, you're not contributing to it anymore typically. So it's a very different conversation around how long that fund is going to last. So there is a requirement for ongoing advice in retirement. I'm just checking time now, sorry. I just want to make one quick point there, and this is in relation to sort of that exit strategy as you get close to retirement.
Yeah.
And it's one of the benefits of that occupational pension scheme for company directors. It's just a fact that limited companies offer far more scope for pension funding than being set up as a sole trader. Okay, it's not fair. It's just the way the pensions legislation is written. Okay, but if you are set up as a limited company close to retirement age and you haven't done much in terms of pension funding, the rules around occupational pensions are really, really flexible. So in this example, if you were 55, you have 15 years service and your salary was 100K, you could actually get the maximum allowable pension fund out to the company if you had the cash, obviously, into a pension scheme. So overnight, you can get over 2 million off the company balance sheet into a pension scheme for yourself. I know that's not a common scenario. I'm just saying that those are the variables that you input into the equation to get that maximum amount of pension fund allowable. You know, if you're 50 years old and you're on a salary of 100K, you can probably still get about $1 million out into a pension scheme. So there's a lot more flexibility around pension funding for limited companies. The closer you get to retirement, what we'd say to sole traders is, because it's much more restrictive, you need to start earlier and make a more regular contribution as you progress through your career, you know, because unfortunately this flexibility is just not there for sole traders. You have to just make your maximum, if you can, your maximum contribution every year, and just maximize your release there, you know.
We have a question, Andy, you'll probably get to answer it also, which is there a maximum for the amount of funds I can put into my pension fund?
Yes, there is, and it depends on whether you're set up as a limited company or a sole trader. Okay, So if you're a set up as a sole trader, you can contribute a percentage of your net relevant earnings, your income for the year, essentially, based on your age. Okay, so if you're in your 40s, you can contribute 30% in your early 40s of your salary, for example, and that would increase up to a maximum of 40% as you get into your late 50s. Okay, so basically, if you're a sole trader, you can just contribute a percentage of your earnings based on your age. Okay, so that's why I was saying every year, if you can, try and do the max. So it starts off at 15% for people in the 20s, and then it kind of increases 20, 25, 30, 35%. So every year, if you can, you just contribute the maximum amount, and it's quite straightforward for sole traders. Okay.
Yeah.
If that client is set up as a limited company, then the amount that the company can contribute, and it usually is the company contributing on their behalf, not them personally, will be dependent on these factors here essentially on screen. So their age, whether they're married, how many years service they have with the limited company, whether they have any pension in place already, and what their salary level is. So that's kind of the first calculation we do, is give us all your details. This is how much you can contribute. Now, is there flexibility to, for example, increase your salary? Because that could allow you to get a lot more into the pension. Obviously, there's a balancing act there between paying more income tax.
Yeah.
But if you're a limited company, it depends on how long you have salary service, your age, and that type of thing. What I would say for limited companies, it's really important to start drawing salary as quickly as you can. It doesn't matter what level of salary it is at the outset. But one of the variables in that equation is how many years service you have, and that's how many years salaried service. Okay.
Okay.
Obviously.
And does it have to be with the same company, Andy?
Yeah, with that company that you're looking to fund from. Okay. So obviously you can change your salary, you can change your retirement age. You can't change the date at which you started drawing a salary. Okay, so that's one variable that just can't be changed. So you may as well, even if it's only a nominal salary initially, just start taking something so you can build up that salaried service.
Yeah.
Okay. So if that person who asked the question, Rose, wants to send those details through, then and no problem if it's if it's anonymous, I can just run the calculation, send it back to you, and you can provide that person the information.
Sure.
So okay, I just want to talk a little bit about risk, and I'm just conscious of time, so I won't go into a huge amount of detail on each one, but we've kind of covered investment risk to an extent. You should be comfortable with the level of risk you're taking, and there's a trade-off between growth and risk. So the more growth you want, the more risk you have to take. It's not a bad thing, particularly over 10, 15 years. But just be aware of what that investment journey is going to look like, and be comfortable with the level of volatility that you're going to take. In post-retirement, we need to talk about longevity risk, so the risk of your fund running out before you die, basically. And I won't go into sequencing risk because I am just conscious of time and I have a couple of other slides to cover, but really inflation risk, I think, is one that's worth discussing at the moment. So you might look at investment risk in isolation, but you really shouldn't, because if you're not taking investment risk, then you're taking other risks. Okay. And this is a slide that I've been using for the last couple of years, which was really reflective of the negative interest being applied to pension bank accounts. Okay, which was close to negative 1%. And I always used 2% inflation as on the other side of the equation, which is obviously the ECB's sort of target inflation rates. That's what they want to see the Eurozone experiencing an annual rate of 2% inflation. And over 10 years, that equated to a 25% in purchasing power, So if you just left your money sitting in cash, and you were being hit with negative interest, and you experienced 2% inflation, then over 10 years, that means your money's worth 25% less. So if you don't take on investment risk, there is a serious impact on what your pension fund is going to be able to buy you in retirement. The the problem now is obviously we're going to experience a lot more than 2% inflation over definitely over the short term, and it remains to be seen as to how long this inflationary growth is going to carry on for. But it just sort of underlines the point that we have to look at your future income requirements. So, go back to the example, let's say you said you needed 40,000 euro in retirement, but we have to ask you, do you mean 40,000 euro in today's money, or in euro terms in 20 years time? Yeah. So 40 grand today might really be 60,000, of income required in 10 years.
Yeah, purchasing power. Yeah.
Yeah. So there is a risk inherent just with having cash in a pension fund, and that is inflation risk, and it's not going anywhere, and it's probably going to get worse. So if you have time on your side, we would suggest you invest your fund for growth and accept the fact there's going to be a lot of volatility in the short term, because the alternative is your fund could fall by 25% in real terms or more if inflation exceeds 2% over 10 years. Okay, so it's not a pretty picture in terms of the inflationary environment at the moment. I suppose the other side of that is if you take on more investment risk, you should expect more growth over the long term. Okay, so it means less of a contribution required to achieve that. I've just used an example of €1 million fund over 15 years. Okay, it's a nice round number. I know not many of us are going to have a fund of €1 million, but if you were to achieve 5% investment growth, you'd need to contribute, or your company, depending on your circumstances, would need to contribute 44 grand a year to achieve that fund. If you're only achieving, say, 1% investment growth over that time, you'd need to contribute 61,000. So it's not just protecting your fund against inflation, it's also reducing the amount, obviously, that you need to contribute to actually achieve your target fund. Okay, and you run the same calculation for a 300 grand fund or a 400 grand fund. So investment risk is not a bad thing once you're comfortable with what that investment journey is going to be like, and you should be taking some risk with your pension fund over the long term.
And Andy, would you recommend talking to your financial advisor about changing your current pension portfolio to say, look, I know I was very, very cautious a couple of years ago. I want to do a couple of years in high risk and then lower down the risk kind of as you're approaching retirement? Or
yeah, so we would always say take as much risk as you're comfortable with. Okay, and that might mean that might mean changing your comfort levels a little bit.
Yeah,
and having an in-depth conversation with your financial advisor to say, look, I know invest in a cautious portfolio. It's performed what it's supposed to do is giving me 2%, but inflation concerns me. I need to get more growth. What type of portfolio should I invest in to get, say, 4%, 5% over the long term?
Yeah.
And what is that investment experience going to be like? Okay.
Yeah.
So what they should say is you'll experience a lot more volatility day to day. Don't be checking your pension fund every day on the online if you have access to one. Check it every 6 months. Contribute as frequently as you can. As I've said, going in monthly means you spread the risk over the 12 months rather than going in once a year. And once you're comfortable with what that investment experience is going to be like, and you don't think it's going to cause you sleepless nights if the fund falls by 6 or 7% overnight, which is possible, then take as much risk as you can. Okay, but it's almost like there is a bit of financial coaching there as well to say, yes, you can invest in a cautious portfolio. This is what they've done. So you would have had a very steady sort of comfortable investment journey, no massive peaks or troughs, but 1 to 2% a year is what you would have got.
Okay.
Or you can invest in something more aggressive. This is what it would look like, some significant ups and downs, but you would have got 5 or 6% over that same period. So it's really having that conversation and understanding that, like, historically speaking, you'd be better off putting all your money into the equity markets. Okay. No, I wouldn't do that, because I wouldn't be comfortable with that level of volatility.
Yeah.
But I definitely want some exposure to equities, and I want considerable exposure to equities because that's where the growth is. So it's just finding that balance between the level of volatility you're comfortable with and the growth you want to get.
Yeah.
So let's see. Okay, just some final thoughts then, guys. So I suppose the point of this slide is really think of a pension. It's not just retirement funding, it's also a way in certain circumstances to extract cash from a company.
Yeah.
Even if you're a sole trader, it's a way to lock away funds from the business into a personal asset, So
yeah,
it's not just retirement funding, it's also sort of protecting yourself. And it's one relief really among others that you can use it as a tool. On the self-administered pension side, this is the current picture in terms of the types of assets you can invest in. What's going to happen is you're still going to have greater investment choice in a self-administered pension than in a master trust, but it's likely to get more restrictive than it is today. So there's going to be a maximum percentage, probably 35% of your fund that you can invest in off-market assets like property. Okay, property is still the one that we hear the most about. So I don't think that's a bad thing personally, because it's going to be more diversification. You won't have clients with all the money in property, and we know where that went in the past. But
yeah,
you're going to have some money in equity, some money in alternative investments like wind energy, solar, and some money in property if that's what you want. And what I'd say is just make sure the investments, if you are going the self-administered route, tie in with a retirement plan. You don't want to have all your money tied up in illiquid assets like property. And you're coming to take your benefits and you want to get a quarter of the fund out tax-free, you have to sell the property, and might not be a good time to do that. So again, if you're going the self-administered route, just make sure your investments tie in with your retirement plan. I have said already, there's a need for post-retirement planning. So it doesn't stop when you take your benefits. You're still going to have a pension fund to manage, and you need to talk about estate planning and stuff like that in retirement. So hopefully you'll work with your financial advisor the whole way up to and beyond retirement. And just some final thoughts then, and again, happy to take any questions, time allowing. I'd say pensions is still a very tax efficient way to build personal wealth outside of a business, any business. There's plenty of change coming, as I've kind of covered in this morning's presentation in the Irish landscape. So do take advice. It's very difficult to try and get a picture of what's happening by reading what's going on in the papers, because often journalists only have a particular piece of the puzzle when they're writing stuff, and things are going to change significantly. So it is worth sitting down with a financial advisor. And the last point, as we sort of progress down this pension simplification agenda, your options, particularly your investment options, are likely to become more restrictive. Okay. So if you are considering setting up a pension and the investment side of things interests you, then I'd say do it sooner rather than later, because there is a direction of travel here, and it's into a more sort of standardized pension offering across the industry.
Okay, makes sense. Andy, thank you so much for giving us an insight there. Hopefully that's helpful as a kick-off to people. It does seem like it's quite personal though. So I would encourage people then to reach out to Andy. Andy's got his email address up there. And we know from previous clients and subscribers to Accountant Online that Harvest Financial are very helpful when our clients have reached out to them. So in terms of Andy, you keep an eye on all of the queries that come in. So I know you look after our clients. So thank you very much again for joining us today. And do drop us a line for anybody who's joined today, who is listening back on the recording. Do drop us a line if you'd like to hear more about pensions. In particular, Andy, I think you do a special one, which is just about self-administered, isn't that right?
Yes, we do. We have I have a presentation just about self-administered. Happy to do that, Rose. Might be worth doing after September, once we know what the story is.
And also feedback from the community here, what they'd like to know more about. And so thank you, everybody. Have a great rest of the week, and do let us know what you thought of this morning's webinar. Thank you, Andy. Bye now. Thank you. Bye.